Hi, I'm Nathaniel Eckman. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and, finally, answer your questions. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and, therefore, has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer, or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The December jobs report made for a mixed reading. The headline figure showed that the nation created an estimated 50,000 jobs during the final month of 2025, falling short of the median forecast of 73,000. It capped a very uninspiring year for job creation, with an estimated 12-month gain of just 584,000 positions. However, the latest report also showed a downtick in the unemployment rate to 4.4. This paints a Goldilocks picture of the labor market, with employers cautious on the hiring side, but the rate of layoffs remaining low. Meanwhile, the inflation picture is improving. While getting to the Federal Reserve's target rate of 2% is proving difficult, inflation appears to be moderating. The December Consumer Price Index, or CPI, report provides no surprises, but the core CPI, which excludes the food and energy components, increased 0.2% on a month-to-month basis, coming in below expectations. This relatively benign CPI report, along with the aforementioned soft labor data, keeps the possibility of a few interest rate cuts later this year on the table. That said, we expect the Federal Reserve to pause on the interest rate front at the next Federal Open Market Committee, or FOMC, meeting, which commences on January 27th. This would give Fed officials nearly 2 months to assess more data. The risks on both the labor and pricing side of the central bank's dual mandate to manage employment and prices remain contained, and the economy is showing signs of reaccelerating. This setting does not scream for another interest rate reduction this month. All the while, the value of precious metals continues to rise. The price of gold recently passed the $4,600 an ounce mark, hitting a new high. The demand is being driven by concerns about the nation's rising debt level, the declining value of the U.S. dollar, the bickering between the Trump administration and the Fed, and increased geopolitical concerns. The latter has picked up recently, with the developments in Venezuela and the unrest in Iran. Conclusion. The U.S. stock market got off to a solid start in 2026 with the expectation of a strong year of corporate earnings and a more accommodative Federal Reserve, particularly under new leadership later this year, driving equities higher. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading on stocks, bonds, and cash. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line Digital Booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, you'll first head to the dashboard, where I am already located, then click on the Investment Survey under Traditional Online Access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is opened, navigation is as easy as flipping the page. Or, alternately, you can jump to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access these reports. First, you'll head back to the dashboard, where I am once again located. Under the quick links, you'll click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserves over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted every week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock's safety rank, an important tool to measure risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now, let's move on to the one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available but require a higher tier of subscription. If this interests you, please call 1-800-VALUE-LINE. Today, we're going to be looking for reliable companies that balance strong year-ahead prospects with good return potential over the long term. We'll start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1, highest, to 5, lowest. with one including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 2 or better. By applying that first criteria, we've trimmed our potential candidates down from 5,700 to 418 candidates. Next, we're going to filter for timeliness. The timeliness rank is used to predict the relative 6 to 12 month performance of stocks in the value line universe. The format is an easy to understand scale from 1 to 5, with those ranked 1 being the best performing issues on a relative basis. Most often, buyers will want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better. Applying that filter, and we are now down to 78 candidates. We also want a stock with relatively predictable earnings. This metric can be found in the lower right-hand corner of a stock page and is based on a scale from 1 to 100. Today, we're looking at companies with a score of 85 or better for earnings predictability. Applying that filter, we find ourselves down to 45 candidates. We want to target equities that are likely to continue to perform well over the intermediate term, and to ensure that, we're going to focus on stocks with 18-month appreciation potential of 20% or better. By applying this screen, we've chipped the list of prospects down to 19 candidates. Finally, we also want a stock that will generate solid returns over the longer term. To screen for those, we'll be looking at stocks with 3 to 5 year total return potential of at least 15%. Applying that filter, we find ourselves down to the final 8 candidates. They are Becton Dixon & Company, ticker BDX, Chemed Corporation, ticker CHE, Cigna Group, ticker CI, Comcast Corporation, ticker CMCSA, Eaton Corporation, ticker ETN, FactSet Research Systems, ticker FDS, Hubble Inc., ticker HUBB, and Marsh & McLennan Companies, ticker MRSH. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Eaton. Before I click on Eaton, that is Eaton, ticker ETN, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top. Now, let's click on the last full-page report on Eaton. Eaton is a diversified power management company and global manufacturer of highly engineered products for industrial, vehicle, construction, commerce, and aerospace markets. The company, which is set to announce fourth quarter results in early February, likely finished a good 2025 with positive top and bottom line comparisons. During the third quarter, orders accelerated, resulting in a book-to-bill ratio of about 1 to 1. About 1.1. Orders from data centers were especially strong, advancing 70% from the previous year, and we believe that trend continued during the December quarter, resulting from insatiable artificial intelligence or AI demand. We are expecting that bottom line growth will pick up momentum in the recently begun year. Eaton continues to benefit from the build-out of electrical infrastructure and data center construction to provide the computing power needed for AI. Orders and backlog are expected to increase over the next 12 to 18 months as the pipeline of new business is likely to remain robust. These shares are a timely choice for the year ahead, while 18-month appreciation potential is also healthy. An above-average earnings predictability score and a favorable safety rating are also positive attributes that should entice conservative investors. A respectable dividend yield helps sweeten the pot and provides some downside protection. Our 3 to 5 year target price range for the stock is $410 to $560 per share. Our stop loss is $253.47 based on yesterday's closing price. In summary, Eaton has strong earnings growth potential, which should lead to above average share price gains. It is today's one stock to buy right now. In a moment, we'll go to our question and answer section, but before we do, we would like to note that we have sold one of our previous one stock to buy right now recommendations, Progressive, ticker PGR, as its fundamentals and valuations have changed since we presented on it. Now, we'll tackle your questions. Please note we typically can't answer complex questions about specific stocks on the spot, and for that we recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand things off to Alan and Charlie. Take it away, guys.
Thank you, Nate. It's Charlie Moran, and I had a question submitted earlier. Someone was interested in knowing what the three figures in the bottom right of the value line page mean. Those are the earnings predictability, stock price stability, and price growth persistence. Well, the earnings predictability is a measure of the reliability of an earnings forecast, and predictability is based upon the stability of year-to-year comparisons, with recent years being weighted more heavily than earlier ones. The earnings stability is derived from the standard deviation of percentage changes in quarterly earnings over an 8-year period. The most reliable forecasts tend to be those with the highest rating, that being 100, and the least reliable, the lowest, is 5. The price stability rating is a relative ranking of the standard deviation of weekly percent changes in the price of a stock over the past 5 years. The ranks go from 100 for the most stable to 5 for the least stable. And finally, the price growth persistence is a measurement of the historic tendency of stock to show persistent price growth compared to the average stock. The value line persistence ratings range from 100, highest again, to 5 being the lowest. The second question we had was regarding the target price range. What is the value line's target price range that you see that is typically 3 to 5 years hence to the right of the array on the graph that appears on each page? When your strategy is long-term growth, your goal is to buy stocks with potentially above average price appreciation. Our analyst-derived 3 to 5 year price target price range is one of your most important tools for identifying these stocks. Target price range is a forecast of where Value Line expects the average price of a stock to be in the next 3 to 5 years. The range is based on our analyst's informed estimate of company earnings during this period, multiplied by the analyst's estimated price-earnings ratio for the same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrower band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. Because the analyst calculates target price range using an estimate of future earnings based on information available at the time it is calculated, this measure is subjective. As company performance changes in the future, the target price range will also be altered. Those were the questions that I had. Alan, had you seen any come across the screen?
Someone just asked, how is Eaton positioned to benefit from the AI boom? And there's a few different reasons why we think it is well positioned in that industry. It does play a critical role in AI data center infrastructure. It's a power management leader. AI data centers require vastly more energy than traditional ones. Eaton provides some of the necessary components for that. The company has a grid to chip strategy. Eaton is focusing on moving power efficiency from the utility grid directly to the high density chips within server racks. It should also benefit from some strategic partnerships. And as noted earlier, it is seeing record demand and backlog. The third quarter, for instance, Eaton reported a 70% increase in orders from data centers. The backlog is also strong. Based on these factors, it's looking to increase capacity. In fact, it's investing about $50 million in a new Virginia facility, and we look for that trend to continue going forward. Thank you.
I'm seeing a request if we could show the screener again. Could we pull that back up, please?
Sure.
Yeah. So just to review the criteria that we used for the screen for this were a safety rank of 2 or higher, a timeliness rank of 2 or better, earnings predictability of 85 or better, 18-month appreciation potential of 20% or better, and 3 to 5 year high total return potential of 15% or better. And you can find all of those things on that sidebar there and then enter the relevant numbers for each one to get the screen that we used today.
Yeah, thank you, Nate. I'm not going to click on each one individually, but I'll show you where to find it. Safety rank is right here under ranks and ratings, as is timeliness rank, as is earnings predictability. So those three can be found underneath ranks and ratings. 18-month TPR midpoint is underneath company data right here. And the
and like
the total return, I'm sorry, is underneath projections.
Yeah. And, you know, as was mentioned, there's 50 fields here in the basic. There's 100 more if you have the higher subscription tier. You can get very granular with, you know, exactly what you're searching for to fit your portfolio with these. And, you know, like for these presentations, you know, we're obviously screening for good stocks, but because we're trying to recommend to a broad group of people, we're not necessarily getting super duper granular with some very niche things. And you might want to if you're looking for something for your own portfolio. You know what you need best, and we have all of these fields to support that. So, are you seeing
Yeah, I'm not seeing any further questions. We thank you all for joining us.